Hello, welcome everybody. SF Live episode 176. This is it. Wednesday afternoon. It's Wednesday already. All the days blur together. So, Wednesday afternoon. And we'll be joined by Bob Thompson. He's a senior vice president and portfolio manager at Raymond James. He also publishes the Gold Digger report to his clients as well and audience. But he's also a frequent guest on Sprott Money and their weekly wrap-up show. So I'm quite excited to have him come on and talk about the mining clock. Where are we at in the sentiment or in the mining cycle right now? Is it time to invest, time to sell, time to hold, or just to look? And we'll talk with him about that. How is he allocating his clients' money, of course, as well. We're not going to get into company names. It was hard enough to get him on through compliance, so I'm not going to jeopardize that with him. But before we switch over to Bob, let's be reminded that to follow us on YouTube, follow us on Twitter, and make sure to hit that little bell notification as well. As you know, we do all our interviews live. That way you do have an advantage and you know what's going on live as we are chatting with our guests. Also, make sure to use the hashtag function AskBob, B-O-B, on Twitter. We'll see the questions come in, or use the YouTube chat, of course, as well. And we'll sprinkle the questions in if it seems fitting, or we'll ask the questions at the end of our conversation here with Bob as well. And make sure to use that. It's an interactive format. It's for you. It's live. Make sure to use it. Now, without further ado, actually, let me switch over to my guest. Bob, it's great to see you. Thanks for coming on SF Live.
Hey Kai, thanks for having me on the show. Appreciate it.
Yeah, it's great. I've been hearing your name and seeing a lot around, and it's great to catch up. And as I said, you're a frequent guest on Sprott Money as well, and you do the weekly wrap with Craig Hemke as well. So it's great to see you. Thanks for taking the time.
Yeah, okay, fantastic.
So I said a lot about you already, of course, but why don't you give us a bit of an introduction? You're first-time guest on SF Live. Like, who's Bob Thompson, and what does your day-to-day look like?
Sure, I've been in the business 25 years and manage discretionary money for clients. And most of my clients are kind of C-level mining executives. And because it's an interesting sector, obviously, it's a sector that I focus on. But it's good because I'm a generalist too, right? I can buy bank stocks for clients or utilities or things like that. And I think sometimes with that big picture, top-down view, it really helps to see where you are in the cycle. And it's important. Rick Rule once said, he said, everybody should be rich after one cycle in the mining, in mining, because the highs are so high and the lows are so low. Things go up many hundreds of percent. So why aren't we all rich if we've been in the cycles many times? And you know why? Because we do the round trip, right? And that's especially the case with mining executives who have concentrated positions in their own company stock. So we do something called lifestyle planning, right? If they need $5 million to live and they have $10 million of their stock, great, sell $5 million as the cycle goes on, make sure you're doing fine there and let the rest ride. So, that's what I enjoy about the business is the cyclicality of mining, and that's why the mining clock is so important.
Interesting, like very interesting comments there. Like a completely different perspective because we talked off mic as well or off camera before, and you consider yourself a generalist money manager. Like you're not with a focus on gold mining, but you have a more generalist approach, which is really refreshing because you have different views on things.
Right. Yeah, I think it helps.
Right, so like for me, example, I told you before, like I was just watching actually the closing bell because a lot of financials came out and how those are affecting our sector as well. Like I've didn't really used to do that. Like it's fairly new for me. So seeing that Ford actually is struggling massively because of a global chip shortage is quite interesting to see because it affects our sector, right?
So it certainly does. And I mentioned I've been in the business since 1996, so I kind of went through that tech bubble in 99, 2000, and it's funny you say that to people in the industry today, and people look blankly at you because very few people in the industry today have went through that tech bubble. But I see so many similarities to what happened there, right? And you have to think of yourselves as a generalist. I mean, there's only a certain amount of capital in the market, and that capital flows to different sectors depending upon where people see the opportunity. And as long as the tech stocks, like they were in 99 and early 2000, are roaring up, or all the other speculative areas outside of mining, people don't pay attention to mining, the generalists. So the sector only starts to move and the valuations only start to increase dramatically when the other sectors roll over, and then people say, okay, what's a good thing to invest in? And then money starts flowing into the sector. And we look and say, wow, why did this just start to happen? Well, it's all because of money flows in the market.
So as a generalist manager, it's actually great having you on, like trying to get a bit of a different perspective because we've had discussion internally as well. Like what do the majors actually need to do to attract more generalist interest? Like I know Newmont has been doing well, and just as an example, as of late, as they increased dividend and they started buying back shares. Is that the right way to go?
Yeah, I mean the dividend is the way to go, and obviously that's what a lot of generalists look for. Everybody's looking for income these days, so if you can clip a 3 or 4 or 5% yield, that's sustainable, right? But the problem is in our industry and why the dividends aren't so high is because people look and say, what's the sustainability of this dividend? Are you gonna increase the dividend every year for the next 10 years? And when you're in such a cyclical business like this, where your profits depend upon an underlying commodity, it's really hard to guarantee that, right? Now, having said that, I think ExxonMobil has increased their dividend every year for 50 years or something like that. So you can do it in that sector, but I think that's what the companies have to start to do, the big blue chips in our sector, and say, here's a sustainable dividend that we can give you and you can count on for a long period of time.
Yeah, I'm glad you brought up Exxon because my example mentioning is you because they're paying 6-7%. They're reinvesting. Like actually, oil was negative just as of last year. Like you actually got $35 when you took a barrel of oil as delivery, right? Like how does that work? Like why are the oil companies, like as an example, since you mentioned them, are working that? How is that working?
Pretty good. You have to be very good with your balance sheet when you do that, right? To maintain lots of cash on your balance sheet. And of course, if you maintain lots of cash on your balance sheet, you're going to start to get criticized in the good times because people are going to say you're not aggressive enough. And we'll get into that with the mining clock because it's really important. When you start to see things happen in the market, it tells you how late you are in the cycle. So you have to be kind of criticized for being too conservative in the good times in order to keep that dividend sustainable. But companies here, some of the big blue chips here in Canada, Exxon's been very good at that. So you don't want to be blowing your brains out at the top with debt.
Well, debt is an interesting point because we're in an extremely low interest rate environment right now, and it seems like the mining companies are always doing the wrong thing at the wrong time. Right, so we are all deleveraging. People are writing off assets. Freeport is cutting exploration spending still because they're trying to get off their debt load. Or shouldn't the big companies like a Barrick actually take on debt and just start buying resources and ounces?
Yeah, I mean, this is the time in the cycle when you should do it if we're in the second or third inning. But unfortunately, they do it in the eighth or ninth inning, right? Because their stock prices have gone up a lot. They can use stock for currency, etc. But yes, you should leverage at the bottom. And somebody asked me a long time ago, they said, when would you use leveraged commodity ETFs, like silver ones or whatever the case is? And I didn't mention any names, but I said, you use those when you get capitulation in the market, when you see everything is just absolutely collapsed and the negativity is terrible and nobody wants to invest in the sector and the technicals look terrible and the relative strength and everything on the charts looks absolutely horrible. That's when you use maximum leverage. But nobody does that, right? Everybody uses maximum leverage when everything looks great. And it's just a function of big corporate companies. And, interesting, you'll get these big companies and then you get these small groups like the Lundins, right? Or John Robbins or the Oxygen Group with Mark O'Day. And these are great capital allocators. So what they'll do is they'll find a project, they'll sell it to a major at the end of the cycle. The major will overpay. And then what happens is the cycle crashes, then the major sells it back to them for 20 cents on the dollar. They buy it back, they continue to develop the project, and they sell it back to the major for 4 times what they paid for it 10 years later, right? and it's just having capital at the bottom that is very, very, very important. And for some reason, it's just not the way big corporations think, generally speaking.
It's interesting because we've been like beating our brains like how can we attract the journalists to this space? Like it still seems like the same $20 bill is going around. Right? Like you put $20 into the cycle, eventually you'll get it back. Like the same money. It's not new money coming in, right?
That's right. And I think a big part of that is the market. Other stocks have to roll over, right? Value investing has been out of favor compared to growth investing. It's been the worst in 40 years. So growth investors, there's secular growth stocks, the NASDAQ stock, et cetera. Value investing is the cyclicals, stocks with low PEs, et cetera. So interesting enough, value investing has had this horrible 10-year performance, the same as the mining sector, right? So, and that was the same as 99 and 2000. So when the cyclicals start to go again, then people start to shift into the low PE stocks, the value stocks, and along with that comes the cyclicals and the mining stocks. So we have started to see that. And, copper stocks have had a big run in the last 6 months. I think we're only at the beginning, but that's some generalist money starting to come in.
Yeah, it's like, what do we need to see? Like, I don't see it happening until 2023 nowadays, if I look at it, like, because we're going to keep that low interest rate environment at least until then, based on, and we're going to talk about the Fed actually is perfect segue is,
Yeah.
well, we're going to keep the interest rates low. And today it was a nothing burger. They didn't say anything today, pretty much. It was a non-event, like the closing bell, like all the TV programs didn't even mention the FOMC meeting. It was
Right.
just a non-event. Right.
Yeah.
So when do you see that happening? Like, I've been in the sector for 10 years now, and I'm still waiting for something to happen.
Well, I always say, and this was the title of my last Gold Digger, right? The secret to happiness is low expectations. And it's sad, but it's true in anything in life, right? So we always go into these Fed meetings for gold, for example, with low expectations. The market has these expectations. The Fed's going to get hawkish. The Fed's going to, and I think they want the market to feel that. So you see the gold stocks under pressure. Gold was under pressure this morning. And then the Fed comes out and they're completely dovish and says, no, everything's the same. Everything's wonderful. We're not worrying about inflation. We're not worrying about hot economic activity. It's not our fault. Powell said it's not our fault. What's happening with the stock market. We don't control that. So, then people say, oh, okay, they're still dovish. So then gold rallies and the gold stocks all rally today and the commodity stocks. So it's a little game that they play and, it's moving around the dots. The expectations of the dots going forward, and they're always more hawkish than they actually turn out to be. And the fact is, again, looking from the top down, I wrote a little while ago that if interest costs to the U.S. federal government go up by 0.5% a year, 0.5% a year, that increases the interest cost by $160 billion a year. Now, it costs $160 billion to finance the entire U.S. Navy for a year. So basically, if interest rates go up by 0.5%, you're paying for a whole U.S. Navy all over again. So they can't let interest rates go up. They just really, really can't. If they do, it's going to be billions upon billions upon billions, up to $1 trillion even, as time goes on, of extra interest payments, and it just doesn't work from that respect. So there's only one way you get out of this. Jerome Powell knows it, everybody else knows it, but nobody can say it. And that is, you have to let inflation run hot, and you have to keep interest rates low, and you have to increase, the real rates have to go more and more and more negative. Then what happens is all the bondholders who buy a U.S. bond for 1.5% or 1.7% for 10 years, they only get 2/3 of their money back in 10 years, or half their money, and that's how you get out of debt. And that's how they did it in World War II. At the end of World War II. But the only problem was at the end of World War II, we had just as much debt as we do now, because obviously if, it was a good reason to take on all that debt. There was a war going on, but you had all the troops coming back, you had economic activity, and they grew their way out of it. But with the demographics today, we can't sustainably grow our way out of it the way we did at that time. So they're going to try, but we'll see what happens.
That's an interesting point of discussion, like growing out of it, like, because the debt to GDP ratio is probably the most important one, and either you lower debt or you grow GDP to make it more favorable, right? Mm-hmm. So now coming back from COVID at some point, like we're not over it, but it seems like the US seems to be over it, and everybody's super bullish right now on the economy. Like, right. Is that part of it? And then the green energy revolution, which for me is more of an industrial revolution 4.0, if you want to build, or whatever, 5.0, 6.0, I'm not sure where we're at these days, right?
Right.
Like, and value adding to all the products we're doing, like greening them, or for a lack of a better term, right? Like, is that going to be adding to GDP? Is that one way to do it?
Yeah, I think so. I think people, there's a couple things going on with the electrification, I guess, of our society, and one of them is, I don't think people have got their heads around it yet, that we aren't going to get rid of oil for a decade, right? We're going to have to obviously increase our green output, but it's not going to be done quickly, and it's not going to be done by businesses until it's a profitable venture, right? So that's why all these industries continue to get heavily subsidized by government. And of course, anything that's heavily subsidized by government is not very efficient, generally speaking, right? So we're in that kind of conundrum right now. So we have to have, believe me, if oil was $250 or $350 a barrel, companies would start to look at how are we going to save on energy costs, and they start to deploy capital to different areas. But we're not there yet. Energy is still cheap with oil, and companies are going to use that. So that's the first thing. The second thing is, as I said, people have to get their heads around the fact that just because you're driving a electric car, or just because you have a windmill, doesn't mean it's completely green, right? You have to look at the chain, the supply chain that give that energy output. And a lot of times we're going to see that, you're using a lot of carbon when you do that. I was talking to somebody a little while ago, and she was a real green person, and she said, well, I don't like the uranium sector, because I was talking to her about uranium and how the supply demand fundamentals for that. Because I said, it's clean energy. That's the cleanest energy you could possibly have, is nuclear energy. Oh, I don't like that sector. So I said, okay. So, and you don't like oil. So you like solar panels, and you like wind. And she said, yeah, that's how I think electricity. I said, I think electricity should be done like that too. So I said, you're a big copper fan then. I said, you're a big copper mining fan. No, I don't like mining because that's bad for the environment. I said, but do you realize how much copper is needed to go into an electric car, to go into a windmill, or whatever the case is? And she said, well, I guess there's no way to win then. I said, there isn't, right? I said, you need copper inputs. And I said, if you don't want to have your baseload power created by either oil, or right now, or nuclear, I said, if you're okay to have your lights out for 12 hours of the day, that's okay. That's fine. As long as you're willing to have your lights out. I said, if you're not willing to have your lights out for 12 hours a day, then they have to store all this energy from windmills and solar in huge capacitors or huge batteries. And I said, then you need a lot of copper and zinc and cobalt and everything else. So that's the conundrum right now, is we all want to be green, but a lot of people don't realize what it takes to get there.
It's an interesting discussion. Me being German, of course, like we shut off, or we said, okay, we're going to end runtimes of all nuclear reactors after Fukushima. Like once the runtime is reached, like, okay, we're done with them. Well, we're at some point where we're getting 46% of our energy from coal, right? Doesn't make any sense.
No, I just saw that last week. And actually, somebody talked about, I'm just quoting them, how hypocritical they were being in Germany, because they said, we don't want all this nuclear energy, but so we're going to increase our coal consumption dramatically. And we're like, what are you doing? Or they're going to import energy from France
or Sweden, like who have nuclear power plants.
Nuclear. That's right.
Like it's a bit hypocritical, like, and I've been saying that for years now, but we're slowly coming back. Like, I've seen a couple newspaper articles where we are seemingly changing our way of thinking about that. But I do have one big problem with all of that, is recycling.
Yeah,
and that's one thing, like, Tesla hasn't addressed properly. It's one thing Nikola hasn't addressed properly. It's one thing all the windmill manufacturers haven't addressed properly. It's recycling. What do you do with it? Especially if the windmills are done after a few years, you got these massive magnets and rare earth components that need to be recycled.
Sure.
Or at least stored safely somewhere after use. And that's, like, I'm not a greenie or anything. Like,
no,
but that's something that gives me food for thought, right?
In mining, we call that reclamation costs, right? Nobody used to worry about it. Everybody used to just leave kind of the pit there. But now, obviously, there has to be a lot of money put into planning for reclamation. And I think that's going to have to happen in that sector too, like you said.
Okay. So a lot of factors going into the commodity price environment right now. We're not going to talk agriculture commodities. That's going to blow the format wide open here. But let's focus on your mining clock. And I'm just going to switch over real quick this screen so our audience can see your mining clock that you put out in your newsletter. And I've taken the latest version of it. Why don't you run us through what we're seeing right now?
Yeah, the mining clock is great because it visualizes where we are in the sector. And, George Soros once said, his theory of reflexivity, right? It isn't the economy that controls the market. It's the market that controls the economy, right? So it's really, really important to look at internally what's happening in the market. And that's telling you where you are in the cycle. And it's a credit clock. It's a deal flow clock. You can call it anything you want to, but let's start at 1 o'clock, right? So 1 o'clock, 2 o'clock, 3 o'clock, that would be in the 2014, 2015 area for mining. So companies get squeezed, they're over leveraged, whatever commodity price is falling through the roof, cash flows are drying up. And as we know, in the mining sector, what the great upside is the leverage that we have. The optionality that we have as the price goes up. Well, that optionality or leverage works on the downside too. So you can just see your profits go away completely, and obviously you get squeezed if you have too much debt. So the companies, the Glencores of the world and Tex and things like that almost went bankrupt, like they did back in '08. So you start to see that squeeze happen. So they have to get rid of the corporate jets and
Yeah.
bring down their businesses to hopefully be profitable or at least not lose as much money at the low commodity prices. So then they survive, right? They sell off assets. Usually at pennies on the dollar for what they bought them for many, many years before to really smart operators. And we can talk about that a little bit later too. But then they survive, some don't survive, right? That's all part of the process, and it's a good part of the process because it gets rid of the zombies, right? One of the problems with the Fed's done right now is, by giving all this liquidity to the system, you got all these zombie companies now that should be dead, but they're still alive and they're still sucking up capital. So a normal cycle, that's what happens. That was the end of 2015. So that was 3 o'clock. 4 o'clock, 5 o'clock is when commodity prices bottom and they start to go up again, right? So as they start to rise, obviously companies have got rid of their debt. They've made themselves slimmer. They start to get cash flow positive. So that's important. As they get cash flow positive, then a company will look and say, now we have a big problem, and our big problem is we haven't been putting any capex into the ground, for example. So if we're producing 5 million ounces of gold a year, and we have 35 million ounces of reserves, we aren't going to have a company in 7 years unless we actually go find some more gold or buy some good projects. So they start to take their excess cash flow and they start to do cash takeovers. A lot of times happen relatively early in the cycle, and we saw that actually in 2016. There was a whole whack of cash takeovers for good projects that happened. The thing about the mining clock is that it's not like a real clock. 1 second is not. It can stop for a period of time. It can back up a little bit too. So what we had is the trade war, et cetera, in 2018. That was terrible for copper, terrible for all the base metals. Gold kind of did okay, but it's had a really bad year in 18 up until 19. So the clock stopped for a while. Then what happens is when the price starts to move up again, people start to do some exploration. They start to raise some money and they start to actually explore. So we've seen that in the gold sector, and that's 6:30, 7 o'clock, and that's where we are right now in the gold sector, in my opinion. There hasn't been a lot of junior IPOs. There's been a lot of private placements that have done, and I think part of that is a regulatory structure. There's been a lot of private placements, and something that I said last summer going into September is we saw a massive amount of private placement, massive amount of capital raised in the sector, and everybody was positive on the sector. And Bank of America raised their gold price to $3,000, et cetera. So I said, okay, during a bull markets always end in euphoria, but during a bull market, you get excessive optimism at various times. And when you have excessive optimism, you're probably going to give back a third to half of the profits of the recent gains. And that's exactly what's happened in the last 6 or 7 months. Capital flowed into the copper or base metal industry from there. So what happens is you get all this money going into the ground around 7 o'clock, and we're starting to see that now. Then, lo and behold, you start to get some discoveries, obviously, because money's going into the ground and people are finding things. As these discoveries come up, there's lots of good projects out there. The supply starts to increase, and the big companies then start to look and say, okay, now we have a choice of projects here. But then everybody's cash flow positive, so then there's a lot of competition. So they start to overpay for those choices. Then you get up to 9 and 10 o'clock in the mining clock, and what you start to see there is companies' stocks have risen dramatically. Other companies' stocks, a company that IPO'd for $100 million is now worth $1 billion, right? So they start to do these stock for stock paper takeovers, paper transactions, and using your overvalued stock to buy somebody else's overvalued stock. And that tells you you're getting pretty late in the cycle when that starts to happen. Then you start to see, and I know what you do, and what you do in your business is very valuable to me because it tells me all about deal flow, and I think that's extremely important. So as the deal flow gets bigger and bigger and bigger as you go later on the cycle, the quality of the deals gets less and less and less. That's just the nature of the market. Because remember, people that create deals are suppliers, right? And they are simply creating supply for excess demand. So if there's a lot of demand there, they're going to create supply. And it doesn't matter if supply is any good or not, they're creating it because there's demand there, right? And you start to see that later on in the cycle, and that tells you how late you are in the cycle. And this isn't just for mining. I'll give you an example. The marijuana sector. So late in 2017, I had a young guy said to me, he said, Bob, I know, he thinks of me like I'm 100 years old. I'm just over 50, but, he looks at me and, I know you probably don't understand this, but, the pot stocks and marijuana, this is going to be such an amazing growth industry. This is incredible. And I said, okay, I agree with you. That sounds good. Let's look at the mining clock and let's see what's happening in that sector right now and see how late or early we are in that sector. So, what we saw is companies that were worth nothing were getting taken over in paper takeovers for $1 billion, $1 billion, $2 billion. And I said, all the other internals that are going on, that tells me that we're 10 or 11 o'clock in this cycle. So I said, that was in late 2017. So I said, here's my thesis. In the next 5 years, people are going to be smoking a lot more pot, but most of the companies are going to be bankrupt. Now, there will be some big ones that survive and they do well and thrive and et cetera. And, I said to him, I said, do you think the internet changed the world in 1999 and 2000? And, it was before he was born, but he said, yeah, I imagine it did. I don't know anything else other than the internet. And I said, the funny thing is the internet did change the world and the thesis was absolutely correct. The problem is that 80% of the companies went bankrupt in the dot-com craze because, they traded at too high valuations and capital dried up. But the thesis was right. You just kind of lost all your money with most of the companies. So I said that's important to know where you are in the cycle and to invest appropriately. So that's what the mining clock is all about. But the main reason for the mining clock is for mining executives, of course, our clients, so that as we continue on late in the cycle and they look at their lifestyle planning and say, I want to have my cottage, I want to be on some boards, I want to retire one of these days, we can start to take profits at the right time and do what we should do for them and diversify them.
Interesting, because you got uranium at a 4 right now, right? And we talked a bit about the uranium being pretty much the greenest of all energies. Is that one of the reasons? Are you allocating some investment? And how would you play that right now?
Yeah, I'm definitely allocating to uranium, and here's why. I know some very, very smart people are very negative. I know some very smart people that are very positive, and that's what creates a market. And I try to listen to all sides because otherwise you just get confirmation bias. You just listen to what you want to listen to, and you end up making the wrong decision. So with uranium, in my perspective, and why I'm investing in it is, I think it's a when question, not an if question. So in other words, myself, it doesn't matter to me if uranium sector doesn't turn around this year, next year, or the next year, right? I'm looking out 3, 4, 5 years, and if I think these uranium stocks and uranium bull markets are the biggest bull markets of any commodity bull markets when they happen, and stocks go up many, many times, a lot of times, I'm willing to wait. If I have to wait a year or 2 or 3, that's fine, right? If it happens next year, I'm excited. Or if it happens this year, that's great. But I think it's going to happen because you can't continue to have $60 a pound all-in cost basically for a company and the spot price traded half of that. So we're going to have to eat through the supply. There might be extra supply. It was Japanese utilities before. It was all kinds of places that this supply showed up. Might continue to happen. Cameco is buying on the market now. All their, a lot of their long-term contracts are being supplied from the spot market. So they'll eat through all of that, and then all of a sudden people go, wow, there's not enough uranium around because nothing's been put into the ground, and the prices will skyrocket. But you kind of got to be there. I always say no pain, no gain. Right? You got to be there for the pain.
You got to risk it for the biscuit. There's another one of those, right?
There's another one. That's right.
No, fantastic. And we got one question here from the audience as well. On uranium, do you think there's still enough, or is there excess above ground supply of uranium right now?
That's the $1 trillion question. That's right, and that's what a lot of people say. There is too much above ground supply, but nobody really knows. It is a strategic metal in many cases, so we really don't know. So I that's a timing question. So I don't know if there's too much supply out there right now, but I know that the more people that buy on the spot, whether it's companies raising capital to do that. Whether it's Cameco buying on the spot market to supply their long-term contracts and not having their mines running, we're going to eat through that. And when we eat through that, it's like an elastic band, right? You better be positioned in the sector for that move that starts to happen. And something that's a bit worrisome is the uranium stocks have moved up a lot faster than the spot market has right now. That happens a lot of times. I mean, in the gold sector, gold stocks start to move before the gold price does, and that tells you it's a sustained move. But if you want confirmation, wait for the spot prices to go up, but you'll probably be paying higher for the stocks.
One interesting thing, like that's what I just googled real quick, just to be factually correct. Uranium participation is being bought by Sprott Asset Management to be an underlying commodity for an ETF they're launching, from what I've been reading.
Right.
Is that correct? Is that an indicator that we're trending in the right direction? Is that
Well, it's Sprott's trying to, and I know the company extremely well, and they're trying to be the global commodity leader, physical commodity leader. They've done extremely well with their silver products and gold products, and they're kind of known now as the go-to people for that sector. So it just makes sense that, especially if uranium's in inning one right now, which we probably are, it just makes sense that they're going to do the same thing with uranium. The big deal with that deal is that because of their corporate structure and the way they run their products, they can list in the U.S. market, and if they consider listing in the U.S. market, that's going to increase their liquidity dramatically. So, for example, their silver product, their volume is about 10 times greater in the U.S. than it is in Canada.
Well, by far, like what I've been seeing here, Silver Squeeze, and the audience is definitely U.S. based. Let's start wrapping this up. Like one last thing, like I want to talk about, like gold and silver price. Like you'll get a bit of a forecast from you, right? Get your glass ball out and see where are we headed. Give us some idea. Like you're obviously, I'm assuming, positive on the sector based on where your mining clock is, obviously. But is that just being positive on the stocks, or is that the metal as well?
Well, gold is a monetary metal, but it also is a commodity, right? So what happens? It's a great question you bring up, because gold is always first out of the gate, and that's exactly what happened last year. The gold stocks ran, the base metals didn't, or the gold price ran, etc. Then you start to get this increased economic activity due to all the money printing, etc. So then you start to get economic growth that starts to exceed inflation expectations. So everything's working like clockwork, the exact way that it should. Gold does poorly in that environment. It has a major pullback, and then the base metal stocks start to do well. So gold's still acting as a monetary metal in that case. It's not acting as a commodity. So then what happens is the base metal stocks start to run all the other things, and that's what we're starting to see right now. It happened in the 70s, right, where the gold price actually dropped 40% in the middle of a massive bull market. We were only down 17 to 20 here. That's not bad. I think we got out of it pretty easy if the bottom's already in this sector. Then what happens is later on in the cycle, gold turns into more of a commodity for all the same reasons that the other commodities are starting to rise. Negative real rates, or decreasing US dollar, or whatever the case is. So at the end of a cycle, everything tends to blow out and get euphoric at the end, at all the commodities at the end of the cycle. Now, silver, you bring up a good point. Silver is more of a mid-cycle to end cycle sort of metal. And the reason is because it is a monetary metal, but it is also an industrial metal, and 60% is industrial production. So as gold turns, people start to think of it more as a commodity later on the cycle, silver starts to do that much better, and you get that 2 to 3 times the rise in the gold price with silver, or even more so sometimes. And you see that gold silver ratio come down to, I think in 2011 it hit around 30, right? I mean, it was 120 at the bottom last year in 2020, but that's why you'll get that big increase in silver at the end compared to gold. So your question was, where's the price going? So I think I hate to make predictions at all, but I certainly think gold could rise 50% from here, 100%, very, very conservatively at the end, and silver even more than that. But here's the thing, and why it makes predictions so hard, is that during a commodity cycle, and we talked about this before, this, Kai, I mean, 80% of the gains happen in the last 20% of the cycle, right? So you just can't be selling too early. You got to really wait for the euphoria and wait for the greed. So if gold should be $2,000 an ounce, it could go way, way, way higher than that, simply because the euphoria comes into the market. And that's why it's so hard to actually make predictions of the price, because prices will go out of reason on the downside and on the upside during a cycle.
Yeah, I think we've been presented a lot of examples in recent years. Actually, look at
Hmm.
Tesla. Look at Bitcoin. Those are examples where euphoria has pushed the prices higher. I'm not
Sure.
saying we're coming back to those levels, but of course we've seen some retreatment from those. And
Right.
now it seems like there's a bit of a realism setting in terms of Bitcoin prices. Tesla has come back a bit to reality. It seems like we're still far off in terms of PE multiples on Tesla. Don't get me wrong, but at least the euphoria. But it's a perfect chart because you have that crack up boom where it just explodes.
Right.
It
Right.
pretty much goes
And
straight up.
that's simply due to the greed, and that's the really hard thing. And that's again where the mining clock comes into play, because you look at what's happening in the market. Fraud always happens later on in the market. Briax wouldn't have happened if we weren't in a raging commodity bull market, gold bull market, because people would have actually looked at the numbers and seen what they're all about. But you can get away with that sort of fraud. You can get away with this inappropriate activity as the bull market continues. And we'll start to see that in many sectors as they froth. We saw that in the technology sector, right? Into the Enrons and all those sorts of things back in 2001, 2002. So that's something we look for too. When we start to see salting your core samples or whatever the case was, that'll happen again. It's telling you you're getting late in the cycle. So that's why I still think we're relatively early in the cycle. We're in a mid-cycle correction for gold. We'll have mid-cycle corrections in the base metals too. I suspect everybody is extremely positive on the base metals right now. You see all the investment banks are increasing their targets dramatically for the prices of copper, et cetera. So that makes me a little bit wary right now, just for the next few months, because pullbacks are great. As Warren Buffett once said, he said, why would you ever want anything that you're still buying to go up? Why would you ever want it to go up if you're still buying it? He said, you only want it to go up when you stop buying it and you spend all your money. So those are great times. We're in a bull market for commodities in general, but wait for these, corrections to happen. We've had it in gold in the last 6 to 8 months. We haven't had it in the other sectors yet. So.
Fantastic. Those are great words, wise words to end on. Bob, I really appreciate you joining us. Tell our viewers and listeners quickly, where can they find more about you and where do they find your information?
Sure. BobThompson.ca is the website, and we have a whole section just for mining executives there, or you can email Thompson Investments at raymondjames.ca. And if
Awesome.
anybody wants the Gold Digger, they can certainly grab the Gold Digger. It's a free publication. I just do it because it helps people to keep track of where they are in the sector.
Awesome. Bob, it was great chatting with you. We need to do this more often. And since you're in Vancouver, we definitely got to meet for a coffee or a tea or a beer or something very soon. Once feasible.
That's right. Thank you very much, Kai. Appreciate it.
Likewise. Thanks for coming on. Thanks for your time. And everybody else, thanks for watching. Thanks for tuning in. This was SF Live, episode 176. We were joined by Bob Thompson. He's a senior vice president and portfolio manager at Raymond James. We talked about the mining clock, the Gold Digger, his newsletter, and of course, where are we at in the cycle? FOMC meeting comments as well, and much more. Make sure to rewind or just watch the whole replay when you get a chance. Don't forget to follow us, hit a like, give us a thumbs up, leave a comment as well. What do you think of his estimations? What do you think? Is he completely off? Is he completely right? Do you agree? And also share the video with your friends if you want the others to view this. It helps us on YouTube. It helps us with the algorithm, and others can follow your advice. Thanks so much for joining us. We'll